Lesson 15-3, Adjusted Accumulated Depreciation. So our learning objectives for Lesson 3 is calculating depreciation expense. We're going to use the straight line method, and then we're going to adjust accumulated depreciation. So we're actually going to make a journal entry. There's different categories of assets. Most businesses use several broad categories of assets in their operations. Usually you'll see something like store equipment versus office equipment. Cash and other assets expected to be exchanged for cash or consumed within a year are called current assets. So anything current is 1 year or less for how long they're going to have it. Physical assets that are going to be used for a number of years in the operations are called plant assets. So plant assets would be things that last for longer than a year. Normally you'll think of things like computers or vehicles. The largest and most expensive plant asset a company will own will be a building. With these plant assets, the value will adjust from the date of purchase, and then that adjustment is called the depreciation. So a lot of things will lose its usefulness, specifically technologies. To match revenue with expenses used to earn the revenue, the cost of a plant asset must be expensed over the asset's usefulness. So everything has a shelf life or a term of years in which that object or that asset still has value. So the portion of the plant asset's cost that is transferred to an expense is called a depreciation expense, and that's what we're going to be dealing with today. Typically, there's 3 factors that are considered in calculating the annual amount of depreciation. How much did you pay for it? If you had to get rid of it, how much is that going to be worth, which is a salvage value? And how useful is the life? So how long are you going to be able to use it? So we're going to use these 3 factors in order to calculate annual depreciation. The original cost of a plant asset includes all the costs paid to make the asset usable to a business. So for instance, if you wanted to set up a network, you're going to need the computers, but you're also going to need to account for the internet, all the cabling, all the servicing and the servers. The cost including the price of the asset plus delivery and then any installation costs. An estimate of the amount that will be received for an asset at the time of its disposal, that's our salvage value. So basically, if we were to get rid of this, how much could I sell it for or scrap it for? So salvage value sometimes is used as a scrap value because you're just selling it to a scrap yard, or a residual value because you're passing on the item to someone else at a discounted price. Since salvage value cannot be known when the asset is bought, you basically have to estimate this value. The period of time over which an asset contributes to the earnings of a business, it's called its useful life. Another term that sometimes you'll hear is a shelf life. The total amount of depreciation expense distributed over this estimated useful life of a plant asset. So we're going to actually take how many years this item is useful and divide it by the total depreciation we think we'll acquire. And that's how we're going to figure out our annual depreciation. So the 2 main factors are physical depreciation and functional depreciation. Physical depreciation is going to come into play more with things like vehicles, where there's wear and tear or potential damage due to external forces like weather, such as hail damage or accidents. Functional depreciation would be that possibly there's newer, better technologies. This is going to happen a lot with things like tablets and computers and cell phones. Straight line depreciation, the way that it works is you take the original cost, you subtract what you estimate to be the salvage value, and this is going to give our estimated total depreciation. So this is the maximum that we're going to be able to write off. We take that estimated total depreciation and we divide it by the number of years that we think this item will be useful, and that's going to give our annual depreciation. So you use the annual depreciation in order to actually calculate year after year how much you're going to be writing off. The total amount of depreciation expense, that's going to be your accumulated depreciation. So you're going to calculate that for the number of years that you actually own the item. Once it's discarded, then you'll stop depreciating it. So you'll see it written as 20x2, that's the second year, or 20x3, that's the third year. So they want to know within this time period, what was the total depreciation. So it accumulated to 800 from years 1 and 2, and another 400 from year 3. So after 3 years, we're depreciating $1,200. The original cost of the plant asset minus the accumulated depreciation, that's going to be what we call the book value of the plant asset. So that's going to be what we actually earned or got to use out of this item. So originally the item was $2,500. We depreciated $1,200 for 3 years. So the book value at year 3 is $1,300. These are some of the accounts that are associated with this type of depreciation journal entry. So you typically will depreciate things like office equipment. So office equipment and its depreciation expense is its contra account. And then you have accumulated depreciation. The other one typically is store equipment. So you'll have store equipment, its depreciated expense, and then its accumulated depreciation. So when we actually do journalize that final depreciation expense, this is what it would look like. You would have the depreciation expense of the office equipment debited, and then you would credit the accumulated depreciation of the office expense. And these are done at the end of the year. So what are the two categories of assets? They're either current, less than a year, or plant, more than a year. What 3 factors are used to calculate a plant asset? We use the original cost, the salvage value, and the useful life. What plant asset account does not have a contra account? Land. Land does not technically depreciate. Traditionally, land will appreciate, but that's a whole nother lesson. Does an adjusting entry for accumulated depreciation affect the plant asset account? No, there is no change. Let's go ahead and go into our system and let's see what this would look like. So our first example is we're going to calculate the expense of a colored printer. So we paid $950 for this colored printer. So original cost, $950. It's telling us that the printer has a salvage value of $150. So I'm going to go ahead and plug in my salvage value, $150. We're going to subtract these two values to get our estimated total depreciation. So let me pull up my calculator. So what we're going to do to calculate the estimated total depreciation, we're going to do 950 minus 150. So our total depreciation expense is $800. If we go back into the wording, it says that the useful life is 5 years. So we're going to take that $800 and divide it by 5. So every year, this item, this printer, is going to be depreciated $160. So this is step 1. So let's go on to step 2 where we actually calculate our book value. So in step 2, they want the original cost again, which was $950. After year 1, we're going to depreciate $160. After year 2, we're going to depreciate $160. So at the end of year 2, they want to know the book value. So we're going to go back to our calculator, clear it out. So 950 minus year 1, 160, minus year 2, 160. Our book value is going to end up being $630. So after year 2, this color printer went from $950 to $630. Step 3 in this lesson is actually accumulated depreciation. So actually doing the entry. So these are some different items that we're going to do. It says on December 31st, Southside Electric determined its total depreciation expense. There were 2 items. There was an office equipment, which was depreciated for $21.50, and store equipment, which was depreciated for $74.40. So we're going to journalize these 2 transactions. Again, this is happening at the end of the year. So our date will be the 31st. The first entry is going to be for the 2150, and this is for our office equipment. So it's depreciation expense dash, and it's office equipment, and this is going to be for the full amount, 2150. Its additional account is accumulated depreciation dash office equipment, and it's the same amount, 2150. The second transaction is also going to be on the 31st. This is for the store equipment of 7444. So the account actually looks extremely similar, but you have to remember that one is an office equipment and one is a store equipment. So one could potentially be a plant asset and one could be a current asset. They could serve different values. So it's still depreciation expense, but this time it's store equipment, and this amount is much larger, 7440. And then the secondary account is going to be accumulated depreciation, and this one is still store equipment, and 7440. And that's lesson 15-3, guys.